All right, let's get right into it. For anyone watching the markets, this past Monday looked like a classic risk-off day, right? But if you looked a little closer, a completely different story was unfolding in one specific sector. Today, we're breaking down exactly how a major geopolitical flare-up sent defense stocks soaring. And this slide just lays it out perfectly. You had this stark divergence. On one side, major indices like the S&P 500 and Europe's Stoxx 600 were deep in the red. But on the other, the defense sector wasn't just holding on. It was absolutely thriving. A sea of red for the big markets, but this one bright green pocket for defense contractors. So you have to ask the critical question, right? Why? What on earth is driving this dramatic split in the market? Let's unpack that. The answer, as it so often is in this sector, wasn't hidden in some earnings report or a surprise analyst upgrade. Nope. The catalyst was all about real-world geopolitical events that exploded over a single weekend. So here's the chain of events that really sent shockwaves through the system. Over the weekend, we got reports confirming widespread US and Israeli attacks on Iran. Those strikes, we learned, resulted in the death of the supreme leader Ayatollah Ali Khamenei, a truly monumental event. Iran's response came fast. They launched retaliatory strikes on US bases in the region, which tragically led to American casualties. For the markets, every single step here was a fresh injection of risk and deep uncertainty. And just like that, boom, the entire defense industry just snaps into sharp focus. When the headlines are all about military conflict, investors immediately pivot their attention to the companies that make the hardware. It's really a textbook flight to a very, very specific kind of safety. Patrick O'Donnell from Omnis Investments really nails the mood in the market here. The key word is uncertainty. Investors hate it, and right now, the biggest question isn't just what happened, but for how long is this going to go on? That very uncertainty is what fuels all the speculation about more defense spending and countries needing to restock their military supplies. Okay, so how did all this translate into actual hard numbers? Well, the market's reaction wasn't subtle. It was immediate, it was big, and it was global. Let's start in Europe, where we saw some pretty significant moves. Germany's Hensoldt, which is a big player in sensors and radar, jumped about 4%. On a day when the rest of the Stoxx 600 was getting hammered, that made it a real standout. And then you look across the Atlantic, and reaction was even stronger. Get this. In pre-market trading, a giant like Lockheed Martin was up more than 5%. For a company that big, that is a massive move. It tells you there was some serious investor conviction there. Now, what's so interesting when you look at this table is just how broad this rally was. This wasn't just a US story or a European story. You've got Hensoldt and BAE in Europe both up around 4%, Northrop Grumman also surging over 5% in US pre-market, and then even all the way over in Asia, Japan's Mitsubishi Heavy was up about 3%. It was a synchronized, worldwide move into defense stocks. But, and this is a big but, a smart analyst never gets totally swept up in a rally like this. You've always got to look for the counter-argument. And in this case, a really important cautionary note from Barclays gives us that crucial dose of reality, especially when we're talking about the European sector. So here's the disconnect. Even with these stocks performing incredibly well, Barclays is pointing out that if you actually look at the fundamentals, the real earnings coming from these European defense firms this year, the picture is a lot less rosy. In fact, they've actually seen more negative surprises than positive ones. And this is a perfect example of their point. Take Sweden's Saab. The company posted record results, record backlogs, which all sounds amazing, right? But even so, the analysts at Barclays are hitting the brakes, saying they flat out question the sustainability of that growth. That is a really strong statement of skepticism. So what Barclays is concerned about really boils down to three key questions for anyone trying to model this sector. First, can these companies actually keep up this crazy high growth? Second, are the stocks just too expensive now? Are they trading at a big premium? And third, is it possible the market is underestimating just how fast their earnings could fall back to normal once all this initial spending starts to level out? Which brings us right to the heart of it, the core strategic dilemma. Are we really seeing the start of a new long-term era of growth for defense? Or is this rally mostly just a speculative bet that the conflict will continue? And we have to remember this isn't just about numbers on a stock chart. As former Swedish Prime Minister Carl Bildt reminds us, the stakes are way, way higher. The stability of this region isn't some abstract idea. It has real, direct consequences for the entire global economy. So this leaves every analyst with the one defining question. Do you view this escalating instability as a fundamental risk you need to protect your portfolio from? Or do you see it as a unique and maybe rare opportunity to generate some serious alpha? Your answer to that is going to define your entire strategy in the months ahead.